Today we wanted to talk about conventional loan for future homeowners.
Now, this one has a lot of misconceptions out there, so that's why it's getting its own video, because there's a lot of lies out there that conventional loan, you must have 20%, you don't. There's another lie that you must have 800 credit score, you don't. So conventional loans are not run technically by those government programs. They are their own entity. They are, Fannie Mae and Freddie Mac does set some rules. The Federal Reserve does set our interest rates. However, they are run by banks. So the bank has their own criteria and the banks are there. And so we're going to kind of go through some of the stuff we know about conventional loans.
Exactly. The first thing that we wanted to talk really is conventional loan really don't require upfront mortgage insurance premiums, no? And why is that?
Talk to me about that.
This is different, the way that we are saying, because this is different from the FHA or Federal Housing Administration loans that require this premium. Because for those, even you put 10% down, you still your premium.
You have to pay a fee.
You need to pay fee, exactly.
There's a fee. Also with the veterans, there's a fee. With the USDA, there's still a funding fee. So we do not have funding fees when it comes to conventional.
Which adding to the overall cost of getting a loan.
Now, we're also going to talk about down payment. Like I told you do not have to have 20. We have seen most common 3%, 5%, 10%. There was a group in 2023 that was saying 1% conventional loans. I know nothing about that. I've never actually seen it in action at a closing table. I do see 3, I do see 5, I do see 10 a lot at closing tables. So you do not have to have 20% down in order to buy with a conventional loan.
Exactly. And definitely you can go from range of 10 to 30 years of the term, which helps you if you wanted to pay off your mortgage faster. You can go 10 or 15 years, or if no one wanted to normal, it's going to be 30 years.
Before we talk more about the flexible terms, I think we need to do our introduction.
Let's hit it.
Hi, it's Alan Victoria. Welcome to our channel and podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get notified.
Also, you call text all the time, 252-327-3357. We love talking to you. Don't be shy. Also, grab our buyer's guide and seller's guide in the description below. So with flexible terms, you also have another issue with that, with fixed rate and adjustable rate. So if you feel that the government, the rates are going to be better in a couple years, maybe you're going to go with that adjustable rate. If you are confident that you want a 30-year fix, you can go 30-year fix. But there's a lot of flexibility with this. You can do, a 3-year, 5-year, 1-year, 7-year arm, and then do the rest as fix. You can just fix the total fix. There's also, just like he said, 1-year terms, 5-year terms, 30-year terms. There's a lot of terms out there, so you can kind of make more of a deal bit depending on your situation. So if you're going to retire in 10 years, maybe you need to be on the 10-year plan to buy the home in full as well. So it's just things to think about.
Exactly. And the next thing that is related to our first basically point, but is different, is reduce private mortgage insurance costs for conventional. How much is reduced?
Okay, so when you hit 20% of home value of that home, so let's just hypothetically you bought a home at $200,000. The home is now worth $250,000. For whatever reason, appraisals have gone out, house prices are increased. You've already hit your PMI, so you've already went even if you've only paid 3 or 4 payments on that $200,000 loan. If you can prove that house has appraised for $250,000. You are now not having to pay a PMI anymore if you took a conventional loan.
Exactly.
With FHA, you're not getting rid of that PMI. Exactly. You're stuck with PMI for the life of the loan if you went under 20%. But if you went under 20% with a conventional loan, and then you can prove that house is worth more than 20% of what you actually paid for it, PMI is gone. So you can get rid of it. You can ask for it to go. You can get a BPO broker's price adjust or an appraisal. And then it will just fall off your loan. So you don't have to continually paying it once you've hit 20% in equity, which is lovely.
And most of the banks announce that if it's a loan to home value ratio is 22%, it's going to fall automatically. But it's better to always take an action and you do your whatever, you be proactive to do this. The next thing is really the loan amount. In general, the conventional loan have a higher loan limits respect to something like FHA or Federal Housing Administration loans. And this is actually help you if you wanted to buy a house with a higher price point. The conventional loan could be the best way for you to go.
I mean, here in our area in Pitt County, we don't have those. We don't have to worry about jumbo loans too much. Yes. But in other places, they do have, situations to where the government loans will not cover in full whatever they're trying to buy. So here we do have more options. If you do want to buy $1 million home and you're doing with a conventional loan, power to you, we can do that as well. We can get you with the right people.
Exactly. The next thing that is good also about the conventional loan, you are able to finance more property types with the conventional loan. Yeah. Which is also a good thing. No, for example, USDA or U.S. Department of the Agriculture, they usually don't let you to finance mobile home or manufactured home.
A used one.
A used one, yes.
Or you can have a second home.
Yes. Therefore, conventional loan in that aspect is really helpful for the home buyers to be able to get finance situated.
Also, you can, if you're looking for a second home, vacation home, for investment properties, all of this is going to be conventional loans. So, and you might not, even if you're looking, bank loans are very much a good situation. So these might not be available with other loan programs, but they are available with this one. Now, what about that good credit?
The good credit rewards also is important. In general, for conventional, we need 620. However, if it's some certain point that you need to talk to your lender and see what is that criteria is, and they tell you with that good credit, you get a benefit of a favorable interest rate and terms with the
right.
loan.
So interest rates are kind of set by the government, but better credit is going to net you better terms with conventional. So
exactly.
I mean, these are all things. So really think about a conventional loan. If you qualify for a conventional loan, it is the most traditional one people use to buy loans for houses for a reason. So people typically, FHA is great, but conventional loans typically is the most common.
Therefore, this is all good potential and terms for the first-time home buyers, second home buyers to understand that how the conventional loan can benefit them in home ownership.
So we hope you love this video. We love doing these for you, and we can't wait to talk to you again.
And don't forget to call us at 252-327-3357, Alan Victoria.